how to deal with business brokers and business sellers. So you've searched for some businesses and you've sent some inquiries out, whether that's through off-market inquiries or whether that's through business brokers and websites, and now you've got some first response back. People are now saying, we know that you're interested in looking at this potential acquisition, so how do you deal with these people? What's the process to go through? So let's start off with business brokers, because they're the gatekeepers, and there's certain other steps that you need to take with business brokers which are different to when you're dealing with business sellers. So let's take a look at that first. So when you're dealing with business brokers, the first thing that's going to happen is that they're going to send you an NDA. An NDA is a non-disclosure agreement. So the NDA is, it's the right thing to do, to sign the NDA, non-disclosure agreement, because you're essentially asking for confidential information about a business. Now, sometimes you get a teaser document with that when you're dealing with business brokers. So a teaser document does not give you any specific information regarding the business that is for sale, with the exception of it's in this industry, it has this many employees, and this is the revenue and profit it makes. Maybe some other financial information, but generally speaking, it's just to see. It's actually good, the teaser document. I like the teaser documents when they get sent out, because what it does, it makes me filter the businesses through my deal specification. And if it doesn't meet my deal specification, I don't even sign the NDA and say, thank you very much, I'm not interested in this business. By the way, it's always easier to dismiss. It's better dismiss fast, right? Because you just save energy and you save time. Coming back to that. So you sign the NDA, you sign the non-disclosure agreement, maybe you take a look at the teaser document, and then thereafter, they send you a bit more information regarding the business. That's normally done through something called an information memorandum. I'm just going to write IM here. So that's done through an information memorandum, a sales document. Yeah, so it's good to put sales document as well, because that's fine. So it's a sales doc which is sent over, and it gives you information with regards to the name of the business, the little bit more detailed information regarding the finances, the management team, the shareholders, so on and so on. So this is where you can go in and you can read the sales document and you can read the IM. Now, one thing, I never read their forecasts, right? And also everything that I'm reading in the sales document, absolutely everything, I'm reading with a pinch of salt, because I don't believe 100% what is written in those IMs, in those sales documents, until I verify it myself, okay? So when you're searching for businesses and you're getting these IMs through and you're getting these sales documents through, number one, be skeptical. And number two, always ask for the accounts at the same time. So as soon as I send it through, normally what I do, sometimes I forget, but when I send the NDA back, I say, thank you very much, please send me the IM, the sales document, and also send me 3 to 5 years worth of accounts. So send me 3 to 5 years worth of accounts. Okay, and this is statutory accounts, full accounts. So what that does, it allows me to verify the information which is presented in the sales document and the IM. And what you find is that 9 times out of 10, the financial information that they've put in the sales document, in the information memorandum, is different to what is in their full accounts. So now, like, okay, that's fine, I have to do a bit more investigation. And obviously, when you've looked at as many deals that I have, you can sort of figure a lot out from the accounts itself. So this is actually something from Warren Buffett. Warren Buffett says that something to the effect of your due diligence is reading the accounts. Okay. Now, the businesses that he's looking at, they have accounts and they normally have strategic notes which are attached to those accounts, and that's fine. But I can actually, and because Warren Buffett said that, I started looking more at accounts. Now I can find out a lot of information from just the statutory accounts, and it shows me whether I'm interested or not. It shows me whether it meets my deal criteria or not. Because in the accounts it shows, and by the way, you want unabridged accounts, because what happens is that sometimes they send you the abridged accounts. Now, what are you going to do with the abridged accounts? What's abridged accounts? Abridged accounts is a watered down version of accounts. It's only got the balance sheet on it. So maybe it's got the turnover. So it's got a summarized P&L. Yeah, summarized P&L, profit and loss statement, and it has the balance sheet. Okay. And that's fine. I mean, obviously, a business needs to be solvent for you to be interested in it. But you want the underbridge accounts. You want the full breakdown of the P&L. You want all of the notes from the accountant with regards to the goodwill, with regards to the treatment of the goodwill, how they're depreciating assets, how many employees are there, are there any directors' loans, is there any outstanding tax? All of these things are in the accounts. And that's why when I get the full accounts, underbridge accounts through, I'm verifying what they said in the IM in the sales document. And normally, 9 times out of 10, I'm sending back a whole lot of questions to the business broker to say, right, you said this in your sales document, but the accounts are saying that. You said this in your sales document, but the accounts are saying this. You said this in the sales document, but the accounts are showing something different. So therefore, this is great, because what you're doing, you're putting the business broker on the back foot and you're showing them that you know what you're talking about. Okay? One of the most important things that you need to be able to read and understand and interpret are the financial accounts. Yes? If you don't know how to read financial accounts from the perspective of an acquirer, from an M&A perspective, then you can make some big mistakes, right? So for example, you can have a business which is profitable on the P&L, but is insolvent on the balance sheet. It's insolvent on the balance sheet, meaning that it's in debt. It's actually in debt, right? And therefore it's got negative assets. It's running out of cash, and therefore it's going out of business. Yes? Now there may be some way in which they're running their business through the overdraft and they're getting cash and extracting it and they're using the overdraft. That's a whole different story, no problem at all. You have the meeting with the seller and find out how they're, or the accountant in that case, and find out, maybe the seller, maybe the accountant, whoever, and find out how they're running their business. Obviously, it's not the best way to run the business, and you might still be interested, right? But at least you know that you need to send those questions back to the business broker. So it shows them that you're a competent acquirer, and it also shows them that you're serious, and also it puts them on the back foot with these questions. Now, 9 times out of 10, they turn around and say, oh, I'll have to ask the seller, do you want to, I don't know why I written 9, oh, 9 times out of 10, that's why. So, do you want to set up a meeting? Do you want to, okay, they always say, do you want a viewing? Do you want to set up a viewing? They're still in pre-COVID. Okay, so set up a video call. I like to have video calls on the first instance because I can't be bothered to travel, right? It's going to waste my time if it doesn't meet my criteria. So I want to see the full unabridged accounts, 5 years, and I want to have a meeting with the seller via video call. Then I'm going to find out whether it meets my criteria or not. But before we get to the first seller meeting, let's take a look at some other things. Right, when you get the full unabridged accounts, you will know very, very quickly whether it meets your deal specification or not. And if it doesn't, thank you very much, I'm not interested in this business, move on to the next one. And if it does, that's the only time you're going to go and request that first meeting with the seller. Now let's go on to sellers. Let's go on to sellers. When you're dealing directly with sellers, let's say you've done some outreach, you're cold call, maybe a partner introduced, and you're now meeting with this business owner or talking to this business owner for the first time. Normally you'll have a phone call, then you set up a video call. On that first phone call, all you're doing is saying, thank you very much for meeting with me via phone. Of course, I have this phone call. Why don't we set up a video call? Push for that video call, that meeting as much as you can. So you get that set up, and also say, oh, just before the video call, can you do me a favor and send over full accounts, right? So your last set of accounts. That's if they know that you are interested in selling, buying the business, and they're interested in selling. If there's a joint venture conversation, then you just say, right, I just want to, you don't request the accounts, you just get the meeting appointed, right? So you just have the meeting. But if they're interested in selling and they know that you're a buyer, you can ask for the accounts. If it's a joint venture conversation, you just ask for the video call. So what's the other thing that you do when you're on the call? When you're speaking to sellers, you need to wow them, okay? Because they need to understand that you're the right person to have a conversation with, or you're the right person to have a business conversation with. If you've come on a joint venture basis, the kind of thing that you can say with regards to joint venture and say, yeah, we like to partner with businesses, and the way we do that is that we like to buy some of the shares of the business, right? Is that something that you're interested in, and we can have a partnership on how we can grow our companies together? They'll say yes or no. If they say yes, sometimes they'll be like, oh, tell me more, that sounds interesting. It's not something. Some owners are not interested in selling the equity in the business, like for example me, right? Unless you're going to invest millions and millions in my business, I'm not interested in having any conversation like that. But there are plenty of owners who are. So then you just have that conversation. If there's a warm seller, then obviously you have the other conversation, say, right, can you send me your full accounts? You scrutinize the accounts. Now, when you come onto that video call, what do you say? So with regards to the first meeting, direct sellers normally don't know about non-disclosure agreements. And you could get away with asking for financial accounts and asking for this information, especially if they're a motivated seller. But it's not the right thing to do. So do the right thing and you send them. Say, look, I'm asking for this information, but the standard practice is that we send out an NDA. You know, they don't even know. I was speaking to a business seller the other day, 2 weeks ago maybe, or something like that. 3 weeks ago. And I said, yeah, let me send out an NDA. They were like, what's an NDA? I said, a non-disclosure agreement. She said, what's a non-disclosure agreement? Then I explained it and I said, look, it's the right thing to do. It protects you, gives you protection, so you know that you're dealing with someone who's not going to screw you over. I didn't say in those words, but that's the message, yeah? So she appreciated it. I sent over the NDA and they returned the NDA back. So do the right thing and send an NDA over. Once the NDA has been signed and been sent back, that's when you ask for the accounts. So that's the right way to do it. I know I said on the phone call, ask for the accounts, but do the NDA first, then get the account. Now the whole purpose of this first meeting is to court them, right? It's to court them. And it's to show them that you're an ethical person. Yeah, you're an ethical person. And also, you're trying to help them out of their situation, right? They want to sell. Maybe, for example, their lease is coming up to renewal. Do they want to sign another 15-year lease? And they're, coming up to 60 years old. A 15-year lease will take them to, 75 years old. Do they want to commit to that? So you're trying to sort of wow them, and you're trying to give them the impression that you're the person who can help them. You can help them. Yeah? And ultimately, for motivated sellers, that's what you are doing. Because a motivated seller is someone who has another reason to sell the business. The business has to be good. Yeah? But the person is in a motivated situation. So they're motivated and they need to sell for a personal reason. Now, you ask for the financials, and with the financials, it's very important, the financials have to be clean. Clean financials. If, for example, you see anything wrong with the financials, you say, thank you very much for the interest in the conversation. Unfortunately, it's not something that we can pursue. Right? There's two reasons for that. Number one, if you don't have clean financials, you can't raise money from investors and lenders. They will not give you money. In fact, let me go across there. They will not give you money because, hold on a second, this doesn't even make sense. In fact, I received some accounts, and this has happened multiple occasions, but the most recent one, a third of the turnover was missing. A third of the turnover, reported turnover, was missing from the accounts. You know what they said to me? They said a third of the turnover they receive in cash from their customers, and they don't declare it in their system. They put it under the mattress, right? In their pocket under the mattress. And therefore there's no way that you can verify this turnover. I said, thank you very much. No longer interested. Best of luck with you. Right? A third of the turnover. Can't believe it. So it was, that business was a million business. So it was about 300,000. 300k was missing from the business. Can you believe that? 333k, whatever it works out to be. So you have to have clean financials. Now the other thing, actually, you need to get management accounts as well. So if you remember, I said full unabridged accounts. So full accounts, unabridged, and you have to get management accounts. What are management accounts? So the full accounts are the statutory accounts which need to be made up and declared and filed with the correct authorities. And then that normally is done, for example, a date. So let's say they could be 6 months old. So what's happened in the business for the last 6 months? You'll get that from the management accounts. Now, a lot of business owners don't have access to their management accounts because they don't request them from their brokers and their accountants, but not the brokers, the bookkeepers and accountants. But their bookkeeper or their accountant will have them because nowadays everything is on accounting software, and it's just literally a few clicks of the button on Xero, on QuickBooks, on Sage, just to basically download on Free Agent, just to download the management accounts for the last 6 months in this example on a monthly. You need a monthly breakdown of the management accounts. Okay? Monthly. And you need it on an accruals basis. Accruals basis, not on a cash basis. Because when you're looking at the management accounts and you can see what's happening on an accrued basis, you can see what the true actual fact of the business is on a monthly basis. And then you can determine from the balance sheet, because you need the balance sheet as well. So you can determine from the balance sheet whether they're solvent and they have enough cash to pay their liabilities as they fall due. So you need to make sure that the balance sheet is a net asset position. Now, this is going into valuations, and so maybe it's getting off topic, but in any case, you need to get all of this information from the seller. So get the financial information. By the way, this is not the first question that you ask. Let me wind back. The first question you ask them, so you need to do the NDA, right? But the first question you need to ask them is, and this is whether they come through a broker or whether it's direct. Why do you want to sell? Why are you asking this question? You're asking this question to find out if they're motivated. Remember, you can only deal with a motivated seller. A motivated seller will ensure that a deal gets to completion and that you get a good deal. Whether it's price and terms, whether it's price or terms, it doesn't matter. Only motivated sellers are going to give you that. So when you ask that question, you better be satisfied with the answer. Retirement, illness, divorce, migration, tax bill, bankruptcy. There's so many, for example, young women with young families. So for example, they have like 3 kids in a row and they're like 4 years old and below. That's a difficult situation for a mum if they're running a business at the same time. So yeah, why are you selling the business? You have to just finding out the motivation. Now the second thing I like to ask, so we went into the finances because finances are important. That's actually the third question. So just put that as the third question. First question, why do you want to sell? Second question is, what's your role? Meaning, what do you do in the business? What is your role? What you're trying to understand is how many, because business owners generally, they're doing like 2.5 roles. Yeah, 2.5 roles, 1.5 roles. The owner operators, they're heavily involved in the business. You need to recruit like 2 people to replace them, 3 people to replace them if they go. So what you're trying to understand, how involved are they? And the worst thing is that if they're involved in the sales relationships, that's the worst. If they're involved in the sales of the business, the sales relationships, it's like, I hate it and I don't want to do those deals. And the second is if they're involved in the day-to-day management. Now, that doesn't mean that you can't do deals. I've done deals where the owner was involved in the sales relationship and the day-to-day management, but they wanted to sell the business because they didn't want to do the business side of the business anymore, and they wanted to stay on as an employee, right? So that's fine. That's perfectly fine. But if they want to exit, and we do advise, by the way, that if you buy a business, exit the seller as soon as possible, right? 2-3 months max. Yeah, ideally on day 1. But anyway, so sales relationships and day-to-day management are like the worst. If they're involved in the bookkeeping, no problem, you can replace that. If they're doing the admin, no problem, you can replace that. It's easy. Sales relationship and day-to-day management are the difficult ones to replace. So you're trying to find out what they're doing, how many days they're working. Are they there like 7 days a week? If they're there 7 days a week, they're the ones that are driving the business. When they leave, what happens to the business? Right? The third question you want to find out is about the management team. Do they have a management team? right? If they do have a management team, good. What do they do? Now, I like the management team to be the day-to-day managers, and there's no sales relationships with the owner. If that's the case, that's my favorite situation. So I want to find out from the management team, is there a solid management team there already where the owner's not doing anything? Or is there a management team already where they can be promoted to a actual general manager and drive the business and continue to drive the business? I like the situation where the management team has been in place for at least 2 years. I'm also happy with 1 year, but I'm less happy with 1 year. If I see management team has been running the business for 2 years or more, then I'm very interested in that business as long as it meets all of the other criteria. So we recently took over a business in which the owner hadn't been involved for like 5 years. We wanted to take over a business where the owner hadn't been involved for 8 years. That was the best one. So if you can, and I've got a video on my channel about how Patrick Bet David, he increased the value of his company because initially they gave a really low offer because he was the one that was driving the business. When he replaced himself, and he had to hire 5 people to replace himself. 5 people, right? And then they doubled the valuation, they gave him cash on completion. So that's why I like to see management team in place 2 years, ideally 2 years plus, I should say, 2 years plus, if not 1 year. Because what you're trying to see is that, what is this business going to look like post-acquisition? Look, a business could be a good business for the owner that currently owns it. But it doesn't necessarily mean that it's going to be a good business post-acquisition. For an owner investor specifically, owner operators a little bit easier time, they can get away with a little bit more. But owner investors like myself, for example, and probably like yourself if you're watching this video, then you don't want to be involved in the day-to-day. And you want to see, how does this business look like? Will it be the same? Can it generate the same revenues? When I say same with growth and profits post-acquisition. If it does, go ahead. And meaning go to the next stage. And if it doesn't, thank you very much. Along with the financial criteria, thank you very much for your time. I'm not interested in this opportunity. I wish you the best of luck. So that's what you ask them on the first meeting. Now, the other thing you ask them, and this is really fun. Now, okay, question number 4 is financial, right? So we've already done that because we spent some time on it already. This one is super fun. How much? What do they think the value of the business is? Value of business. What's the value of your business? How much do you want for your business? You just quiet and you listen. You're going to hear the most ridiculous things ever. So they normally come in some sort of multiple of million, right? And you just listen. I say fine, that's fine. They might justify the valuation straight away after, by themselves. If they don't, no problem. Second question, straight after they give you the value and the other, whatever commentary on that. How did you come to the valuation? Meaning, how did you calculate the valuation? Now you listen. Now, by the way, take notes, obviously. In this meeting, you're taking notes. Yeah? This is the best part. This is the best part of the meeting because you're going to hear the worst justifications ever. It's going to be like so much fun. When you become adept in business valuations, you know what you're talking about. You're going to hear the most craziest things that doesn't make any sense at all. Right? You take all of these notes and then all you have to do is, after they've given their ridiculous justifications, very rarely will they say they don't, a good justification. By the way, a lot of business owners don't know their business is worth at all. They say, we genuinely don't know. Then you help them. And by the way, be ethical. You want to get a good deal, but say, look, give them a range, your bottom range, and I like to cap the top range as well, by the way. So look, this is the range, and we look at these things, and your business is, falls into that range. It will fall into that range, and we'll look at it accordingly when you have more information. Now what you want to do is you're taking notes, and all of the things which are not justified, you just ask them questions. Okay, no problem. What about this? Is this this? Is this that? But for some reason, I've got no questions coming in my head at the moment. but I do this all the time. Right. They need to recruit a manager. How much does a manager cost, by the way? You asked the question. How much does a manager cost to recruit in your in this industry? Oh, 75,000. Okay, right, no problem at all. 75,000. How do you pay yourself right now? Okay. I'll pay myself 12.5K and I take dividends. Yeah? No problem. Okay. Let's say, for example, the profit is 500,000. No problem. So your profit is 500,000. That's because you take it to a 12.5K salary, and then the rest is you paid by dividends. No problem at all. By the way, if the manager's worth 75,000, then your profit has just gone from 500,000 to 425,000. Okay, all right. Let's add back something. Let's say 435,000. Whatever the difference is. Oh, why is that? Well, you're going to recruit a manager. That's a salary. Plus you got pensions on top, and plus you got NI on top, especially NI has just gone up. All of these things, other expenses, has gone up to, your profit has now gone down. No problem. Okay, you said you do the bookkeeping as well, right? Yes. No problem. How much does it cost for a bookkeeper? 10,000 a year. Oh, by the way, your profitability just gone down from 500,000 to 425,000. And you start picking through. First, you're going to chip away at the profitability, and then you're going to say, right, let's say for example you come to a profitability of 400K when their profit on their accounts is showing 500K, or what they think is 500K, 500,000 in profit. 400,000, you said you wanted 5 million for your business. So what you're saying to me, you want a 12 times multiple for your business, is that correct? Yes? Yeah, right, no problem at all. 12 times multiple for your business. I know from this industry that the average multiple for a business is, for example, 4 times multiple. Okay? So the maximum that your business is going to be worth is going to be 1.6 million. They're going to throw their arms up in the air. They say, no, 5 million is the minimum. If you don't accept 5 million, then I'm not interested in having the conversation. No problem at all. Now, if they're not motivated, no problem. Thank you very much. And move on to the next deal. There's plenty more fish in the sea. If they are motivated, say, no problem at all. Why don't you have some conversations with people who know about valuations and tell them what I've said. And, come back to me whenever you have those conversations. By the way, I said brokers, they inflate values. Let them inflate the value. This has happened to me multiple times, is that I've called the owner's bluff. The owner goes to a broker, whatever, they say, my business is worth 5 million. I said it's worth 5 million. The broker said it's worth 5 million. So no problem. You need to sell, right? Because you're sick. Your wife's got cancer and you've got a broken leg, and you know that it's never going to get better because you're 65 years old. Yeah? Go and sell your business for 5 million. And if you can't sell your business and you need to sell your business, you've got my contact number, contact me. I've had it twice where people have come back to me and I've got a better valuation than 1.6 million. Sometimes it's 1.5 million, sometimes 1.3 million. Oh, I need to sell. My wife's, on her deathbed. My legs go worse and gangrene. You have to chop the leg off, for example. I can't continue on in the business. No problem at all. We're going to go back to this valuation or even lower. Negotiating table. Always call the bluff of a seller. By the way, there is plenty more fish in the sea. Now, there is one exception. And we won't deal with it in this video. We'll deal with it in another video. Okay, let's give you an idea of it. If a business has got some sort of competitive advantage that no other business has in the industry, then maybe you're willing to pay a premium for it. That's all I'm going to say. Watch Warren Buffett. Warren Buffett, he talks about See's Candy. Let's give See's Candy example. Warren Buffett, Charlie Munger, they went to buy See's Candy, and they said that if the seller had asked for even $10,000 more, they would have walked away. The seller didn't ask for $10,000 more, and they bought the business. That business had returned $2 billion back to them in the 50 years that they've owned that business, or however long it's been, right? They said that Seas Candy taught us that when you have a business which is unique in the marketplace, it's a valuable business, then sometimes it's worth paying the premium because you know the cash flow that it's going to kick back to you over a long period of time. So barring that, always call their bluff, let them go, and then come back to you. And if they don't, no problem, you've got plenty more opportunities. Right, at the end of the call, you need to think, does it still meet my criteria? Does it meet my deal specification, my target acquisition profile? Does it fit within the profile? If it does, continue, and if it doesn't, move on straight away. Don't waste time and energy and money on deals which are not worth it. Just move on. There's plenty more efficiency. And by the way, you'll be able to do all of these calculations. You don't need Excel. Right, forget all of these people. They're going to pull out the Excel at this stage. Or later on, you might need Excel, right? In fact, because you're raising money from investors and lenders, so you need it, right? You don't need Excel. Just cross Excel out. Everything is in your brain. You need to do the calculation in your mind. Now, obviously, you need to kind of like know the metrics around how you're going to raise the finance and what the debt service coverage ratio is going to be, how much equity investors might take, for example. You need to know that, but you have to do the calculations in your head. If you can do the calculations in your head, then you know that it's going to be a acquisition that has legs. It has possibility for you to go out and acquire it. If you can't make sense of it, and you have to go to Excel and punch in the numbers and do modifications to the Excel for it to spit out a positive number, it's not enough margin of safety, and you need to move on to a new acquisition. So as long as you do the calculation in your head and you've got enough margin of safety with the debt service coverage ratio, then continue with the opportunity. Otherwise, move on. And that's enough for this video. If you want to find out more about value acquisitions and equity or enterprise value and selling businesses, then continue watching videos on this channel, and I'll see you in the next video.